we need a system-wide deposit guarantee. And then we need FDIC insurance with appropriate premiums so that these smaller banks can operate. Woke up Saturday morning after the events of the week, pretty convinced that if the government didn't, at a minimum, guarantee deposits at Silicon Valley Bank, we'd have a massive run at pretty much every regional bank on Monday. And my advice was, we need to guarantee all deposits, not just those. And I think, unfortunately, the run is continuing. I mean, if you look at the deposit inflows at the big banks, if you talk to anyone at JP Morgan who works on opening accounts, they're working literally round the clock to take in all the capital that's flowing in. That's not good for our banking system in our country. And that was what I was afraid of over the weekend, which is why I was so public, if you will. So be super, super clear. We have never been short regional banks. We've never been long regional banks. And we were starting to look at possible investment opportunities. And then I decided on Saturday morning, and I sent an email to the team. I said, look, we're not going to invest in any of these banks because I want to be able to talk about this publicly without being accused of talking my book. So the Silicon Valley Bank was, I would say, unique in the disproportionate amount of exposure they had to kind of long duration fixed income assets versus other banks. We've looked at First Republic Bank, which has been an underperformer, if you will, but its balance sheet, its loan portfolio, its business model looks very, very different from Silicon Valley Bank, but it's still getting shot, if you will, in the market, and that's because the government has still not given people assurance that every deposit is safe. And my point is, my overarching point is, we need to get everyone calm. It's a bit like there were runs on mutual funds. I don't know if you remember during the financial crisis. One of the mutual funds broke the buck, if you will, like a money market mutual fund. People were redeeming, and they couldn't give people the dollar par, and that was causing a run on every mutual fund. Basically, the Treasury Fed came in and said, look, we're going to guarantee principal at mutual funds, which is a pretty extraordinary thing to do, but it stopped people from withdrawing their money, so they could be comfortable. And then they put in new regulations about what money market mutual funds could hold, so the same problem would occur. I think basically the same thing has to happen with banks. First, you have to get everyone calm. So first thing you do is you guarantee deposits, on a temporary basis, where that temporary guarantee stays in place until they update the FDIC insurance program to have greater than $250,000 guarantees per account, for business accounts, and people want to keep those kind of balances in banks. And then they update the regime, they charge for this insurance, and then they can get rid of this temporary guarantee at all banks. But if they don't do that, my expectation is, that people are still going to be concerned, and people like yourself are going to move from Silicon Valley Bank to the JP Morgans of the world. And
is Silicon Valley Bank not the safest bank to be at right now?
It is the safest bank. Actually, the irony is, and I tweeted about this morning, there's sort of two banks that now have an explicit guarantee regardless of how much money you put in those banks, right? That's Signature and Silicon Valley Bank. They have an explicit guarantee from the U.S. government. Then there's JP Morgan, there's Citi, there's B of A, maybe Wells Fargo, if you will, that are systemically important institutions because they've got, $250 billion plus, more like $1 trillion plus in capital. And those have the implicit backing of the U.S. government because we said, look, we're going to bail out those institutions if we need to, and we're going to monitor them more carefully. So those are probably pretty safe too. That's why people are putting their money there. And by the way, they tend to be run better, and they're, I would argue, probably overcapitalized today versus certainly where they were before. And then there's the rest of the banks which have $250,000 per account. And so we've created this now 3-tier guarantee system, which is very confusing to consumers. And the people who've been arguing that, moral hazard, capitalism is over. The problem with people losing confidence in deposits is the details get lost in the headlines, right? Once you hear you can lose money with a deposit at a bank, it affects everyone. And there were lines that people were lining up to take money out of their ATM machine, or go into their branch and get a check to move their money someplace else. I mean, this is like embarrassing. And there's a reason why a lot of people bank with these sort of smaller banks. And I'm in a venture capital fund, and the GP was asking my advice on what to do. And he opened an account at one of the big banks, and he was saying they don't know how to bank a venture fund, that makes a capital call and takes in 100 wires, and then needs to send wires here and there. He found it very cumbersome already. So that's one important reason why we need these other banks. The service level can be a lot higher at a smaller bank. But I would say, if not more importantly, a lot of the construction lending and real estate lending and small business lending is done by these smaller banks. The big money center banks are not good at real estate lending. They've kind of gotten out of that business. But, commercial real estate is a major part of our economy, and you have these big banks that don't have a core competency making those kind of loans to developers, etc. And that will cause a meaningful slowdown if these banks lose all their capital and deposits. The way you can manage this risk, firstly, I don't think you should keep a few $100 million sitting in a bank account ever. I don't care what bank it is. The discipline we followed from the beginning of time, if you remember, we were betting against the creditworthiness of AAA rated institutions beginning in 2002, right? So I've been bearish on the rating agency's ability to assess the creditworthiness for a long time. So the approach we take here is, other than cash we need for daily needs, we keep that number pretty small. Everything else is in a U.S. Treasury money market account, or we own U.S. Treasury bills directly. So we're not taking bank risk, we're just facing the U.S. sovereign. And then the cash we keep on hand, we do keep at a JP Morgan or at our prime broker, Goldman Sachs and UBS. And we monitor those institutions kind of very carefully. But actually, there's a case to be made for going back to Silicon Valley Bank now, because they're got a full faith and credit guarantee on deposits, and they're actually trying to, apparently they're saying they're open for business, they're making loans, they're doing whatever. But it's a bit of it's now a quasi-governmental institution. I mean, I think the right thing to do there is just to recap that institution. Again, we need a system-wide deposit guarantee. And then we need FDIC insurance with appropriate premiums so that these smaller banks can operate. That network of banks is important, for the farmer in Iowa as much as it is for the venture capitalists in Silicon Valley. We need a temporary government guarantee because we don't have a non-governmental insurance system to support it. Right? The FDIC system is not a government guarantee of deposits. It's a government guarantee in exchange for appropriate premiums. Right? The FDIC has $125 billion of premiums it's collected sitting in an account that's to backstop, insurance on deposits. It's a good system. The problem is that the amount of insurance available per account is very small, right? Small, not small for your average American's checking account, for sure. It takes care of that, but it doesn't take care of any kind of decent-sized business that has to have money on hand for payroll or working capital or otherwise. And you can't have millions of small businesses trying to assess the creditworthiness of banks on a regular basis. And by the way, the creditworthiness can change dramatically. Silicon Valley Bank was a very solvent bank until rates moved a lot in 12 months.
Bill, if you were sitting in charge of the Fed, what would you do today?
I would call my colleagues at the FDIC and the Treasury. I would say, let's put in place let's announce to the world a temporary deposit guarantee on all deposits. Let's get busy quickly to create greater insurance levels, and let's get that system announced and launched quickly. It shouldn't take a lot of time, right? We already have a regime for $250,000 deposits. We just need to increase the amount of deposit guarantees that are available. We've got to first stabilize the banking system, and the Federal Reserve's principal job is financial stability. Without financial stability, we don't have any kind of stability, let alone U.S. dollar, U.S. interest rate stability. So once you go solve that problem. Now, Mr. Powell has an upcoming meeting where he's got to make a decision on interest rates. And each move of the lever, if you will, or each crank of the, cranking up rates, puts pressure on the system and cracks emerge. And we've seen more of that crack. We've seen glass breaking. And so I think he's got to be very, very thoughtful about whether we raise rates here or whether we pause. And so I think there's a decent chance Powell says, we're not raising rates. We're witnessing, again, if they can I haven't checked the news for the last couple of hours, but if even the foreign, here's an unusual thing. Sheila Bair was an FDIC share Bush administration, or actually a while ago, maybe even Obama, Republican, she's in effect criticizing the FDIC for not having selective deposit guarantees instead of putting in a temporary guarantee and redoing the system. She's making my argument in today's FT that we need that to happen, because if that doesn't happen, all these deposits drain out of these regional banks. They're going to stop lending. If they stop lending, the economy is going to come to a halt, right? It's going to slow the economy very aggressively. So I'd be very wary about raising rates until we've solved this regional bank problem. And it's not just regional banks. It's people are going to start thinking about their small community banks and how solvent they are. There's a run that we can't have another bank closure. We have one more, and it's like, it's going to get messy.
What happens if interest rates go to 6% to quell inflation? Where do we invest then?
I don't think the Fed has to raise rates that much more. You're at a level today where certainly short rates are above or just above kind of underlying inflation. So we're getting closer to the financial policy slowing the economy. My favorite approach, actually, the big problem we have is we've got, and that Powell's focused on, is I hate to call it even a problem, is we have full employment, very full employment, and we have rising wages, so those are starting to temper. The best way to solve that problem is to open up immigration, right? Why force people out of work to slow the economy to get rid of inflation? Why not increase the supply of workers so that we temper the increases in wages? I just think it's a better answer.